Hello, you're listening to Ready, Set, Go Real Estate Investing Podcast, presented by Brandon Elliott. This show will be going over all aspects of real estate investing and is intended to educate, motivate, and prepare you to take action on your first or next real estate investment. For more information, please visit BrandonElliottInvestments.com. Thank you for listening and enjoy.
Welcome back, everyone, to Ready, Set, Go Real Estate Investing Podcast. I'm your host, Mr. Brandon Elliott. I'm excited today. We have a special guest in the house that is coming from the East Coast, New York area, actually, which is fun. We were just there a couple weeks ago and had a blast, Jennifer and I, but I'm from the East Coast. I'm from New Jersey originally. So we got our backyard brother that is in the mortgage space, right? Is a mortgage broker, can really help anybody nationwide, lending purposes. And the last few years, obviously, with the crazy market that we had going up, it was definitely a lending frenzy, right? Like anybody in the lending space was doing very, very well and focusing on a lot of residential new home buyers and so forth, which is amazing. That's great. With the market switching right now, we have a lot of people just sitting on the sidelines, the interest rates going up, jacked up twice higher than they have in the last 20 plus years. And in a short time frame with the recession, with all the crazy stuff on the news, potential war and everything else going on in the world, a lot of people are in fear mode and they're sitting on the sidelines. However, there are real estate investors like us and so many others that are still taking territory, still taking action, and they need Kevin in their lives. So Kevin is going to be able to dive into, really show his opinion on the market, the interest rates, whether you should be buying right now or you should be sitting on the sidelines for some better opportunities coming up. But Kev, for anybody out there that doesn't know who you are, where you're from, what you're up to, do you mind just giving that 10,000 foot view of what you're up to these days in the world of real estate and lending?
Yeah, of course. First of all, Brandon, thanks for having me. My name is Kevin Ng. I'm a mortgage broker. I'm not a bank. So I work with, at any point in time, probably 12 different banks, right? Yep. Depending on what kind of products my clients are looking for, I can do both residential and commercial, but my business is mostly residential. Like what you were saying earlier, 2020, 21, even the first half of the year, people were just buying everything, right? Because interest rate was still low, especially in New York. There's a lot of money coming in, both domestically and internationally buying, right, in New York. So there's always competitive. And for people who used to live in the city, because of the pandemic, they wanted to expand out. So in the basically all the nearby suburban area, including New Jersey, where you used to live, people were buying properties left and right for entry-level homes. However, started, I would say, around March, April this year, when interest rate really started to go up, like I would say almost like 1% a month, people started taking a step back. And also for all the entry-level buyers who just have enough income to qualify for an entry-level home, I would say in both New York and New Jersey area, you need to spend at least $500,000 to $600K to buy a turnkey entry-level home. Those people, once interest rate goes up a couple of percent, they don't qualify anymore. They don't have enough income anymore. So they're out. So I see a big drop of those buyers. However, look at the flip side, because these people cannot buy anymore. They still have to live somewhere. They cannot sleep on the street. So they have to rent.
Yes.
Therefore, on the investment side, I see landlords buying, especially multifamily, all the time. These people don't stop. Like I have a repeat client. He has probably bought like 4 or 5 different properties with me already, but he invests in upstate New York, near Poughkeepsie area. And these properties cash flow very well. And also because the market has shifted, now the banks, they still need to make money, right? So they are all coming out with this, what we call debt service product, debt service loans. Basically, they don't care about your income. They care about the income of the property, right? As long as it cash flows, the house can pay for itself and you have decent credit, you can give them a decent down payment as little as 20%, which is lower than even conventional investment underwriting if you're buying multifamily. Because most of the time they ask for 25% on the conventional side, the full doc side, right? So yeah, the landlords are still buying and the rate's actually not that bad. So earlier this week, I locked somebody in for a 30-year conventional primary purchase, 7.375 is what we're looking at, right? So it's in the low sevens. These debt service loans, 7.75. So it's about, close to maybe 0.5% higher, paying 2 points. But back in the days, pre-pandemic, the difference was like a full percent. Like basically, you know what I'm saying? Like for 30 years, you could be paying 6% and you jump over to the debt service side, no income check, at least 7%. Yeah. Right. So the delta has become much smaller. If you're a seasoned investor, if you've been paying attention to the market, now it's actually a good time to jump in, given that, you can get solid rent, good tenants, and a good mortgage broker.
Yeah. Kev, so you mentioned a couple of great things that I want to kind of dive deeper into. So for anybody out there that doesn't know or understand the concept of like the debt service ratio and so forth, can you just dive into that a little bit better so that people can understand that I utilize that on a triplex that I purchased. It was my second property and I didn't understand it at first, but once the lender explained it, it made sense to me. And I was like, oh yeah, it's because my property cash flows very well. It's a less risk for them and it makes sense. So do you mind just diving into that a little bit?
Sure. So let's take a step back, right? So let me try to explain why you should even consider this. So because of my background, I'm a real estate investor myself. I've been investing since 2016. I kind of understand the math behind the scene. So for instance, you have a self-employed person who doesn't report enough taxes or doesn't report whatever, right? We always have ways to minimize the amount of tax that we pay, right?
Yeah, it's hard to have like your cake and eat it too, guys.
Exactly.
So, yes.
You cannot report no taxes and try to go get a conventional loan for $1 million. It doesn't work that way. Right?
I used to try doing that in the beginning, and then I realized, oh crap, I need to really, I can't write off anything this year.
Exactly. You have to give yourself a minimum paycheck for you to qualify, right?
Yep.
So let's say you're in that boat. You go get a debt service loan. Let's say you want to buy something decent. Let's say $300K, right? Debt service loan. You want to buy something for $300K. Let's say $300K is a loan amount, just for easy math, right? So 2 points is what, $6,000, right? And then the rate is 0.5% higher, which you can do the math yourself, like based on the loan amount, right? Now we talk about $6,000 per property and a 0.5 percentage point high interest rate. I don't need to look at your tax returns. I don't care about your pay stubs. As long as in an area with good rent and you have a decent credit score, 680 and above, you get a loan, right? Now, on the flip side, because people ask me this question all the time, hey, I think the rate is high. I don't want to pay points. How much do I need to report on my tax return for me to qualify for the same property, right?
Under conventional.
Under conventional.
Yes.
Now, you go over the conventional side, you open up a whole different can of worms, right?
Because now they want to see the docs, they want to see everything. The books, they want to see everything, and they're going to be sticklers on it. And so that's the difference here. It's low docs versus full docs.
Exactly. So on the document side, given that you have everything, right? I need to see your personal tax return. I need to see your business tax return. If I'm in the business for less than 5 years, I need to see 2 years, right? I need to run your credit. I need to look at all your other debt, including your car payment, your credit card, your other mortgages. So when all is said and done, I would say at a minimum, because everyone has some form of debt, right? Everybody has a car, everybody has a credit card, right? I would say at a minimum, you need to report at least 100K a year to qualify for all these things, right?
And it comes down to understanding your debt to income ratio at the end of the day.
Right.
So there's certain stipulations. There's certain lenders, if you're going to be in like traditional, and maybe a couple years ago, you could get up to 50, or some crazy lenders would go up to like 55%. But realistically, you want to be at 40% or below on the kind of higher end, right?
Yeah, exactly. So in terms of DTI, you want to be below 45, right? So that I think that's the number. That's a safe number. Like certain lenders allows you to push the envelope, depending on the program, and go up to like 52, 53.
Sure, but you want to stay away from those numbers for yourself,
right?
And,
those
are
more the outliers. Those are more the outliers, right? Because people would come to me because I'm a broker, so by default, I have creative solutions.
Yes.
So people come to me and say, "Hey, do you have like no docs loan that can lend at like 80% for primary at 3% interest rate?" And I'll be like, well, I may be able to find things out there, but those are more the exceptions, right?
Yeah, it's like a needle in a haystack.
Exactly. I don't want to say that it doesn't exist, but you're looking for the unicorn. Yeah. Right. You cannot do business relying on unicorn. It's going to collapse.
Yep.
Right. Yeah. So when you report that much taxes, the 100K, I would say at a minimum, if you report that much income, like 100K, I would say at a minimum, you're paying 20 grand, 25 grand, 30 grand a year in taxes. right? When you have that much income, right? Depending on how good your CPA is.
Yeah.
So if you are a seasoned landlord or investors, you kind of know why a debt service program is very advantageous. Number one, psychologically, it doesn't drive you crazy.
Yeah.
Right.
It's very minimum documents that you need to turn in. So they're judging more of the property itself and the location and that asset class versus everything that the conventional is looking at. So many docs.
Absolutely. And also these debt service programs. So usually debt service programs are for proper bona fide commercial investment, like you're buying a warehouse on an office or building, stuff like that, right?
Correct.
So however, for single family rental, they also have debt service programs available. And the ratio they're looking for is 1.1, 110% or above, which is very low. Because for like a proper commercial investment, let's say you want to go buy 10 unit or 18 unit building somewhere, right? They want at least 1.25, if not 1.3 minimum. So 1.1 is very low. So meaning that, let's say you want your PD payment is $1,000, as long as you can collect 1,100, you get the loan.
Isn't that crazy?
Which is very easy to qualify.
It's freebies, it's very easy to get into those programs. If you do not qualify for those programs, that is not an investment property. You're betting on appreciation only.
Right.
And that's not the way to go.
So I was joking with some of my investor friends that, look, the bank won't let you fail.
Right.
Exactly. The bank won't let you fail. Like they are going to do the math for you. Even if you don't have a lease in place, they'll do the market rent. They'll do an appraisal, look at the market rent. So it's actually pretty safe. And on a high level, if I want to like put out an ad, I would say get a loan with no income. Well, that means I don't need your income. I need the income of the property. But it's true. I don't have to check tax returns and pay stubs and stuff like that.
Yep, that's so good. Talk to me when it comes down to overall the Fed increasing the rates right now. What are your thoughts on that?
I used to work in an investment bank. So I was in IT for 25 years, but for most of those years, I was in a bank. So I pay attention to, CNBC, listen to Bloomberg Radio, and I read the Wall Street Journal on a daily basis, right? Just about, I would say 2 months ago, a lot of the major banks, I don't want to name names, but a lot of the major investment banks on Wall Street were saying that, don't worry about it. We'll have a soft landing. The market's going to be fine. The Fed will do the right thing. Now, about 2 weeks ago, all of a sudden, everyone is saying that a hard landing is coming. It's going to be the longest recession ever. The Fed is losing control of the market. Basically, everything is going down the drain.
Mm-hmm.
So my conclusion is nobody knows for sure. However, if what they're saying is true, given that all the pundits, what they're saying is that we'll have a major recession, there's no way interest rate can sustain at 7, 8, 9%. No way.
Correct.
You'll definitely go back down. I know at least that much, right? So for the first-time home buyers or for people who are just getting into the market, who just experienced 2020, 21, they're like, oh my God, interest rate is more than double. I'm going to rent for the rest of my life. It's game over for home ownership, right?
Have a little hope, have a little spirit in you because it could be coming back down in your near future.
Exactly. So for people who have been in the business for like 10, 15, 20, 25 years, they're like, 7% is nothing. It's actually low interest rate.
Yeah. See, I got frustrated at a lot of people when the interest rates start going up and they start freaking out. It's like, all right, guys, when it went to 5%, everybody's, pulling out their hair like, no, and I'm just cracking up because we've had the lowest interest rates in history for the last, 10, 15 years at this point. And it's crazy. But I do understand the flip side to that, right? Just like you mentioned earlier, the people that were just qualifying, that were just making it, now they're getting kicked out of the game. They're out of the game, really. They can't purchase anything, so they're forced to rent. However, there's still a lot of opportunity out there. Yes, as it goes up, it's a little frustrating because every point, especially out in California or certain other areas, we're locking in rates today on a remodel. It was going to be a flip because of the market. We're turning it into a short-term rental.
Short-term rental.
Yep. And because of that, it's just one of those things that, we're going to pay a premium because it's all $1 million plus out here. So every $1 million, it's an interest rate point. That's an extra 1,000 plus. So it does add up per month. But if you can still make it work, understand that in the near future, I think they're predicting sometime in the beginning of this year and into the spring, it's going to start dropping significantly again, right?
Yeah, because I have a lot of different clients in different fields. A lot of them are business owners.
Yep.
And I have people in the restaurant business, in the retail business. They see these things much sooner than a lot of people because they are basically on the street, right? They feel the pulse of the market.
Yep.
I got this guy, he's in the food industry. He said that basically between early September to now, business dropped 10 to 15%. He can see that coming for sure.
Yeah.
People are feeling the pain in their pocketbook.
Yeah. Are you keeping a pulse on the bonds and obviously how that fluctuates the overall interest rates on a daily basis?
So I try not to go crazy over the 10-year yield and, mortgage-backed securities and stuff like that, right? Because, they're somewhat related, but not exactly attached. Especially the 10-year yield. A lot of people are like, oh, the 10 years over 4, what's going on right now? Or it dropped back below 4, what's going on? On my end, the rate could be exactly the same. They're somewhat related, but they're not exactly tied to each other 100%. Mortgage-backed securities, yes. MBS, if you look at that number, it's completely tied to the rate, very closely related, but not the 10-year yield. And sometimes these banks, they're smart. They preemptively increase the rate. So let's say the Fed is going to increase the rate by 0.75 in, let's say, November, right? The rate's already higher on my end, like on the bank side. They have to preemptively add it in. So by the time the Feds actually increase the rate, my rate actually may be lower or the same. It's interesting. It depends on what the banks are doing. What I see right now, some of the banks, especially retail banks, they're lending on portfolio loans, meaning they're not using Fannie and Freddie money. They're lending their own money. The rates are attractive. They're usually ARMs, but those are limited because they only have so much cash that they can lend.
Sure.
So we will see how long those programs will last.
What are your thoughts on ARMs versus, adjustable rates versus fixed in rates?
I would say it depends on your risk tolerance and how closely you follow the market, right? Like if you know the market pretty well, if you've been in the market for some time and you're actively buying, I would say, go for ARM product. Go for 7-1 ARM, 10-1 ARM, and you have a very high chance of refining yourself out in a year or two.
Yeah. Now, what I used to be very fixed on, I needed a fixed 30-year or, I needed to fix something because I don't like the idea of being on the other end of that if time runs up and then I'm forced to, do a cash out refi or whatever it is or readjust the rates because what if it's up or, whatever it may be. However, what I've realized is the odds of somebody actually keeping their loan that long, unless it's like their primary residence. But even with that being said, most people are taking advantage of the capital that is the equity or overall selling it, refinance, getting a lower rate, just like you were mentioning. And what we are in agreement on is like in the near future, in the next 2 to 5, 7 years, right? Like most adjustable ARMs, the rates will drop down. So then if that's the case, then you would want to do another refi to be able to lock in a better rate, right? Save yourself some money.
Yep, absolutely. I would say that's a pretty good strategy.
Yeah. So it really depends on you. It depends on the investor. It depends on the individual that is getting these rates. However, really think to yourself that most likely there's a huge chance that you're going to want to do something with this mortgage again in the near future.
Yeah. So because I switched from a corporate W-2 job to being self-employed in 2019.
Sure.
So I have this perspective, right? It also depends on what will happen to you income-wise in the near future, right? So let's say right now you have a super good W-2 job and you think that you're going to become an entrepreneur and start your own business, right? Then I would just go and get a 30-year fixed.
Yep.
Because you don't know what the trajectory looks like for sure in the next few years, right? So
that's good. It depends on so many factors. So really know yourself, know your roles, your job, all these other things that has a big part to play. But also identify that there could be, the longer you wait, the more appreciation you're going to get. I don't care what market, like even if it dips down, if you hang on to it, it will go back up. Yeah,
like I doubt that, especially in New York, I seriously doubt that there will be even a dip. It might go sideways for a little bit.
Sure.
But there's no inventory. There's zero inventory.
And
people tell me,
Yeah, that's the thing. I wanted to kind of transition into that. The low inventory, the supply and demand, that's what it really comes down to. A lot of people that want to get into real estate, they don't have the opportunity anymore because of the rates and the inflation and job loss, whatever it may be. So they're getting kicked out. However, there's still a huge shortage in the supply that we have, although inventory is starting to stack up a little bit because nobody's buying right now except investors. So what are your take and what are your thoughts on that?
So it all depends on the area, right? Like right now, I'm in Long Island, New York. So we have pockets of area where the houses are super popular because of the school, because of access to, train, highway, whatever it is, right?
Yeah.
We still have bidding wars going on right now at this moment. We still have bidding wars going on. There's still people want to buy, right? People with a lot of savings, they may not need to borrow as much. Yeah. I'm not talking about people who can only put down 5% down payment. These are people like 30, 40, 50% down payment.
Sure.
If they're not cash buyers.
Yeah, right? they can pay cash. Yeah.
Yeah.
There's a lot of cash out there, guys.
Right.
Yeah.
They can put down a gigantic down payment, right? Therefore, the high interest rate actually doesn't really impact them that much.
No.
Right. We're not talking about, all of a sudden paying additional $1,000 a month, even with the higher rates. And because I also have friends who are builders. They're afraid to build at the moment, right? Because you don't know what the market is going to look like. So we really don't have a lot of inventory, especially in a town that's really popular. People have been living here for some time. The schools are good, infrastructure is good. And I tell my clients, look, it's not like buying a car. If you're buying if you're looking to buy a specific vehicle, right? You can wait a year, come back next year, they'll still make it, unless they discontinue the model, right? But for a house, once you buy the land, that plot of land is yours. No one else can take it.
Yeah.
Right. It's like playing Monopoly. Once you buy the train station, no one else can buy the train station. And that's it. Whoever lands on that train station stop, they have to pay you.
Yeah, that's good. What kind of learning curves have you seen over the years being in the industry for just people either wanting to get started or not taking advantage of certain rates, lock-ins, whatever it may be?
I would say buy whatever you can afford, right? Like, look, don't overstretch yourself, obviously, right? If you can afford it, if it's within your range, go get that piece of property. Because if I can go back 20 years and tell my younger self, like, one thing to do, always be buying as long as you can afford it.
Oh, yeah. You mentioned something before we actually got started, a nice little quote that I wrote down, sell what's on the shelves, right?
Correct. Sell what's on the shelf. Yeah, because these products, they change. So back in 2021, we're just selling 30-year fixed. People come to me for 15-year fixed. I was like, why bother? I mean, the rate is not that much better. And you don't know how things are going to turn out for you. You could lose a job, business may not be doing well. Then all of a sudden you're in the jam, right? Like you can always pay faster if you want, but you cannot pay slower, right? So if a 30-year, you can compress it, pay it off in 15 years. Who cares? But if a 15-year, now you're locked in. You cannot stretch it out to 30-year.
Yeah, I remember when I got started in real estate, I was working for an investment company here locally in San Diego, and they like cherry picked me because I was doing door-to-door sales for Kirby vacuum cleaners, and I became good at it, but I got cherry picked from them. They were like, hey, we need you, because it was 2011. It was a time where there was a lot of NODs, notice of defaults, a lot of pre-foreclosures going on, and a lot of people believing that they were going to be totally fine by just setting themselves up with modifications on their mortgages. And some people were. Other people were totally uneducated on the whole process of the modifications and how to structure it properly, how to save themselves, and how to not make the same mistake that they did previously by getting in default before it turned into a foreclosure, right? So I'm curious, any thoughts on the market, pre-foreclosures? We see foreclosures starting to increase. I think a lot of people during COVID or whatever it may be, the last couple of years, job loss and so forth, they thought that they would get bailed out with a lot of things. And
right.
And who knows what it looks like. I don't have the crystal ball, but I can see the numbers starting to increase.
Yeah, it's funny you said that. Right before we started this interview, a realtor just texted me. She said she's looking for an attorney that she can reach out to talk about being the go-to realtor for foreclosures and this type of properties, right? Again, it depends on the area, because I would say that our lending standard has improved so much since the last cycle. A lot of people have pretty good income and a lot of equity in their houses, right? Yeah, obviously, there are people who bought just recently with a 5% down payment, and they're really stretching it with like 3-4 borrowers on the same file. yeah, those could be on the verge, right? If one of them loses their income or loses their job, then, God knows what's going to happen, right?
Yeah.
Exactly what you're going to do, right? But I would say for the most part, people have a lot of equity in their homes, especially those who bought pre-pandemic. I mean, real estate value probably went up. I didn't really look at the numbers. Probably I would say easily 20%, right? 20% between 2019 to now. It went up so much.
Sure.
Everything went up so much. And also because of inflation, I doubt that a lot of people would choose that route. That's the way I see it.
So even if it did, just from ignorance, it did go to foreclosure. If there's enough equity, I've heard in certain states that these guys, it goes to foreclosure, but then after the bank gets their money back, plus whatever else, all these other fees, there's still extra money left over. Like these owners are getting cash. They're getting a check later on. And it's like, are you kidding me?
That is crazy. Yeah, most of the time, if you're in a very hot market like where I am, some retail buyer is going to buy it. But basically, someone's going to jump in and step it up.
Oh, yeah. Most of my friends will. Yeah, somebody's going to jump in,
Exactly. Same here.
Yeah, that's good.
So, it probably won't get to that point.
Yeah, you're right. Is there a step-by-step or something that you have for somebody that wants to go the traditional route? I know we talked about the creative route of the debt cover service on certain investments, but if they want to get their ducks in a row and really start searching around for a property, what should they do on the lending side to be prepared for this?
I see. So let's say you're a first-time home buyer who wants to qualify for a conventional loan, right? I always tell
quick question. I don't want to cut you off here, but I just thought of this when you said first-time home buyer. Is there any products out there that are like giving extra benefits for the first-time home buyer? I know that used to be a big thing back in the day, but I keep hearing people ask about it, and I'm like, I don't think that's available anymore.
Right. So a lot of people use that for marketing purposes.
Yes.
Right.
Yes. Thank you.
What I'm saying? So I get calls all the time. I know that certain state or certain city, they might have special programs from the government.
Yeah.
Right. Those are more like the unicorn.
They're
more the outliers, right? And also it takes quite a bit. It's the government. You're not going to get that funding in 30 days. It's going to take a little bit.
Yeah.
Right. So in a hot market, in a seller's market, forget that. No seller is going to wait 60 or 90 days.
Please forget that, everyone. Please forget that, because I keep hearing this and it's just the lack of knowledge behind it. It's something that they heard 5-10 years ago, and then they're still holding on to it, or they're getting hit with the marketing, I guess.
Yes, exactly. Because everybody uses that as like a soundbite, right? It's like, hey, we have first-time home buyers program, blah, 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 right?
It's the clickbait. Stay away from that.
It's a clickbait. It doesn't make a difference, right? Like most of the time for these banks, they don't care.
Yes.
What they care are three things. Number one, you got to have good income.
Okay.
Right? So depending on how much you want to buy, obviously you need more income to sustain it. If you have a W-2 job, meaning that you work for somebody, you work for a corporation, and you make good income, awesome. You're super easy to qualify.
Yes.
If you make overtime income or bonuses, make sure you at least stick to that job for a couple of years, because it might be questionable when the time comes to use the bonus amount to qualify as your income, right? Let's say you never received bonus before. All of a sudden you start a new job and 50% of the income is coming from the bonus. Very questionable. We may not be able to qualify you, right? So number one, income. If you're self-employed, like what we touched on earlier, make sure you report enough income.
Yeah.
So that's one of the things that I tell my friends who are self-employed is like, hey, look, it's year 2022 right now. We're in October. Looking at your tax returns, you don't qualify, but hey, next year is only a few months away. So do what you need to do.
Yeah. Do what you need to do. Write the right amount. Don't write off everything. You might need to pay extra in taxes. However, it's going to allow you to be able to qualify for these loans that you're trying to get and scale for your goal. So
exactly. And
you got to figure out the pros and cons.
You have any question, reach out to me, right?
Yeah.
So income is number one. Number two, you got to have good credit.
Yeah.
Right. So do not trust what you see from your bank app or from Credit Karma. Right.
Your Vantage score. Stay away from that.
Score. There's a different algorithm.
Yes.
Right. Obviously, if your score is super high there, it's highly unlikely your mortgage score is super low. But there are different algorithms. A lot of times, you never know. A lot of times, my client will come to me and say, "Look, on my phone, it says I have 820 credit score. run their credit 750.
Why am I at 700? You know?
Right, exactly. I was like, I cannot tell you. I didn't write the algorithm, but you know, when I use my, you know,
it's legit.
The credit report, right? It's legit.
It's legit.
I forgot the exact name for it. They have like different names for different algorithm. I forgot the exact name. All I can say is they are different.
Yeah.
So make sure you get your credit run or pulled by a mortgage professional. Right. They're all different. Like I think the credit report for car leases, they're different. For credit card, it's different. So make sure.
Yeah, there's different FICO scoring models. Like 7, 8, 9.
Correct. Yeah, different numbers. Yeah, exactly. Right. Yes. So credit score, that's important. I would say in the mortgage world, most of the time, 760 is the perfect score. Some banks are looking for 780. Once you have those numbers, you're golden. You're good to go.
I was going to say, I tell this to everybody because we're in the credit space as well, of like educating people how to fix credit quickly, but how to really be able to leverage, how to get as much credit from these banks and then leverage it property to purchase properties and all these other aspects. But if you have, for any real estate investors or anybody just trying to get the best of the best rates, you want to be within that 760 to 780 range for your FICO, like your true FICO, guys, your true FICO score, not your Vantage score, to be able to get the best rates and to get those instant approvals.
Yep. So number 3 is your reserves, meaning how much cash you have, right? So you got to make sure that you have solid down payment. I would say if you can put down 20%, that's great. Then you're not paying mortgage insurance. Now, here's the myth. A lot of people think that if they have very little down payment, they have to go FHA. You don't. Like for conventional mortgage, you can put down as little as 5% down payment, right? If you take the FHA route, you can go a little bit lower, but FHA has upfront mortgage insurance and monthly mortgage insurance, both, and they don't fall off until you refi.
Yeah, I think you can get it re-looked at once you go over the 20, like once you have 20% equity, you can get it recalculated, but in many cases, it can be a pain.
Right.
So it's best just to do the refi.
So for conventional, you can go up to 20%, you order your appraisal and you can get it taken off, right? So yeah, those are 3 things, basically income, credit score, and reserves.
I love that. Now, when it comes down to reserves, how long do you typically need? I know you're a broker. You've seen it all over nationwide. Is it normally just the 6 months or is it 12 months of all of your expenses plus the new mortgage that you're going to have, those for about 6 months long?
So it depends on the product, right?
Yes.
So I would say most of the time they're looking for 3 to 6 months.
3 to 6. Okay.
3 to 6, depending on the bank, right?
Yep.
I'll say 6 is a pretty good number to use.
Yes.
And 6 months of reserves of all your mortgages.
Yes.
So if you have been doing this for some,
if you're a real estate investor like me and you got a ton of properties and you just got to do the math on every single one of like the total mortgage, interest, taxes, and they want to see 6 months for every single asset that you have, plus your expenses, you know, so all of these things are going to be calculated to see what your total nut is going to be basically. And that needs to be covered.
Right. Absolutely. So yeah, so those are things to pay attention to.
Is there any lenders that you've seen that request like 12 months for reserves?
Not on the conventional side. On the debt service side,
yes,
especially cash out, I have seen 18 or even higher.
Wow. 18 months?
18, yeah.
Wow. When I first got started back in 2015, like I said, I had a triplex. I still do, but it was underneath a debt coverage service. So it cash flowed great. It was perfect, but I needed reserves of 12 months. And I looked at that and I was like, wow, that's a good amount that I just need to be showing and sitting in the bank. And I don't, at the time, especially, I'm still very similar, but right now I need to have reserves. So I got comfortable with it. But at the time I was like, I don't like ever seeing money sitting in my bank. I want to put it to work.
So to be fully transparent, it's not just cash. Your 401k account also counts. Your retirement funds is also part of the reserve. Even your stocks and bonds, but they don't count 100% depending on what it is. Yes. Most of the time, I think they only count 75% or even 50%. Depending on what it is.
Because it can fluctuate.
Exactly. I had a client once came to me. He was like, I got 100 grand in Bitcoin. Does that count? I was like, no, sorry. They don't count that yet. Because that can go down like 80% in a day.
If you want it to count, by all means, liquidate it right now.
Right. Exactly. Exactly. Yeah. Unfortunately, we don't start counting Bitcoin just yet.
Yeah. And rightfully so, because it dropped down pretty seriously. So
it fluctuates too much. It's just too unpredictable at the moment.
Yeah. In the future, by all means.
Yeah.
Cool, man. So income, credit. So focus on your income, whether it's W-2 or self-employed. Just if it's self-employed, really make sure that you have all your ducks in a row, because when it comes down to it, and I really highly encourage people to get organized in the beginning. They're going to want to see at least 2 to 3 months of pay statements, pay stubs. They're going to want to see your bank account statements. They want to see the reserves. They want to make sure that your credit score is on point and nothing derogatory in the last year or so. All these things are very, very crucial to be able to set yourself up for success. And there's nothing worse, in my opinion, than to constantly dealing with a loan originator or somebody that they don't have the expertise yet. So then they're just sending things to underwriting, and then underwriting constantly comes back like every other day with a dozen things that you just got to keep shooting over. So it's best to have everything prepared and prepped prior so that you can send it over and have minimum things coming back from the underwriting.
I want to add one more thing to what I just said that a lot of people don't pay attention to, right?
Sure.
A lot of the time, especially these days, because like what you said, properties are a lot more expensive and rate is high. So you need to bring in a co-borrower, or sometimes even the future mother-in-law. So you have you have your girlfriend plus your future mother-in-law, you have 3 people, right?
Oh, geez.
The bank will look at wherever score is the lowest,
yes,
and use that FICO score for the file.
Yep.
So make sure that everybody has good credit.
Yes, please.
That's one thing that you need to pay attention to.
Yeah.
Sometimes you don't know, like you could have like 800 perfect score on your end, and then your better half, spend all the money shopping, whatever, and she has 680, then it's gonna ruin your file.
Yeah, or vice versa. So it's like I see it all the time, and they don't know. They're like, "Well, I have 800, and then we're gonna be great." And then you have your co-borrower on there, and you didn't even think to ask these tough questions.
Right.
Yeah, so that's good.
It happens a lot, actually.
Oh, it does. I believe it. I've heard of. I've heard a lot of people. And what is frustrating being in the credit space and education overall, I've noticed a lot of people not preparing for this aspect of it with the credit, like one of these main pillars that you're talking about here, until it's too late. Mm-hmm. Like they're in the middle of underwriting, or they're in the middle, and they're in a 500 FICO score and they're about to get their credit pulled. And they're like, how can anybody work with that? You need to prepare yourself like properly first, so that you can have all your ducks in a row. So focus on your credit, focus on your income and how you're going to justify, getting this product and getting these loans, and figure out which product you're going to have to go with, the arsenal of different options that you have because of how you position yourself, really.
Yeah, because the psychology of buying a house, usually when people go buy a house, naturally, they think of the realtor first, right?
Yeah.
And so they'll always go to a realtor. They're not going to go to a credit repair person or go to a mortgage person.
Yeah.
But in reality, they should have done that first. If anything, they should have prepared themselves financially.
Yes. And you should get pre-approved first. And you should don't go to one of those lenders. I hope my father-in-law doesn't see this. He'll get upset. But but the other day, he's been wanting to get a property. We've been encouraging him the last couple of years. And then, now he's got the fire under his butt. He wants to do it now. And we told him, you got to go get pre-approved first. And so he went to I think he went to like Bank of America or some damn lender, and just did like a little basic BS one that, you need a pre-approval letter. Here you go. And that's not legit. It's not.
You can go to a website and get one. Yeah, basically.
You can. And that's frustrating, because now you're submitting offers. You're going to have the documentation needed to submit the offer. However, you really don't know what you qualify for. You really don't know what your safe point is, what your threshold is, and you're getting a little bit more risky out there. Plus, you're not prepared first. What if you get that offer accepted? Now you got to start running around like your head cut off, trying to get all your documents together, because the lender's going to be putting the pressure on you.
Yeah, you got to protect your deposit. You can lose a deposit.
Yeah. So you want to be smart about that stuff. Be intentional. Get your stuff prepared first. Then get your pre-approval, get like a legit pre-approval that they see all your documents, and then talk to your realtor to start getting out there and finding your deals.
Absolutely. I would say if you're buying a house, let's say 6 months from now, you should start the process now. Get pre-approved, get an idea, what kind of numbers you're going to be dealing with. Your monthly payment, it's not about the rate. It's about how much you can afford on a monthly basis.
Yes. And the monthly, so the rate too, not to go on a rant, but like there's another thing that drives me crazy is like the rate fluctuates each and every day. Like, and there's nothing you can do about that, right? Like, depends on when you jump in and lock it in. It is what it is, right? So you can keep a pulse on it, keep an eye on the bonds and how things are going to see where and when you want to lock in your rates. But I always encourage the origination fee. The origination fee is what changes between all these different banks. So that's something that you're going to want to pay attention to because
closing cost.
Yeah, the closing cost behind it.
The closing cost in general. Yeah, closing cost. Yep.
Yes. So
people would come to me and say, oh, I got this bank. They are like so cheap. They're still giving me 5%. I was like, let me see the fee sheet. Let me see the loan estimate. I wonder if they're charging you like 2 points behind the scene. A lot of the times they hide it. They try to bury it. You don't really see it.
Oh, yeah. So Bank of America, for example, they used to claim and say, we guarantee we'll beat any rate out there. And I was very impressed by that. And then I saw that their origination fee was ridiculous. I was like, oh my God, you'll charge 5 times the amount of any other, normal origination fee. So these closing costs add up like crazy.
Yeah, it's unfortunate because I guess when one bank started doing it, all the banks started doing it.
Yep.
So you can go to, let's say, since we're naming names now, you can go to the Chase website.
Yep.
When you look at their quote, when you look at the very small fine print on the bottom, that's font size 2, it tells you are getting that rate with, I think, 1.5 points or something like that.
Yeah.
There's always points attached to the rate they're giving you.
Yeah, it's crazy. Weird times we're living in, but it's exciting to see there's so much opportunity in front. So, final thoughts, Kevin, when it comes down to somebody that is ready, they have all their documents together, they are prepared, but because of the fear, because of what they're watching on television, they're kind of sitting back on the sidelines. They want to get started into real estate investing. They want some cash flow. They see some good properties, but they're just not pulling the trigger. What's your advice for them? Go in or stay on the sidelines for getting deeper into this recession? What do you think?
So I'm going to give out a few points and I'll let these people make their own decision, right?
I like that.
So right now, the con is the rate is high.
Yes.
Right? So that's the con. Okay. So let's put that on the side.
Yep.
Now, what are the pros? You can negotiate with the seller.
Yep.
You can potentially take your time with the whole process. The seller is not going to dictate all the terms.
Yep.
Right?
You can get creative again. Yep.
Right. Like just to give you an example, up until I would say 2-3 months ago, a lot of sellers, because they wanted to capture the equity increase, they're in a hurry to sell.
Yep.
But they had nowhere to go.
Yeah.
So all of them were asking to stay in the house for an extra 1 week, 2 weeks, 3 weeks. And I would tell my clients, especially if they're buying it as a primary, look, all of a sudden you're a landlord. You're not you're not living in that house anymore.
Yep.
I'm not an attorney, but if something happens, they can sue you. You're responsible. Also, your insurance is different.
Yeah.
There are all these consequences that people don't think of, right? You don't have to worry about that anymore. Like, I doubt that sellers are asking for that right now, at least not that often, right?
Well, they're not going to have that power anymore because
the leverage.
The leverage. Yeah. There's not 20 offers on the table anymore.
Exactly. Like most of the time you have maybe 2 or 3 offers, unless for some exception, most of the time, your offers are getting looked at like pretty seriously because there are not too many out there, right?
Yep.
And also rent is going up and up. Rent is going up so quickly. It's ridiculous.
Yeah.
So you have to do your calculation. If you're still cash flowing, you're bringing good cash flow. So what? Like if the rate is high, marry the house and dace the rate.
I like that.
That's the saying that they have in the market right now. Yeah. Because the rate is not going to be permanent. Even though it says 30-year fix, most people only stay in their houses for less than 7 years.
That's good. Yeah, that's good. I love it, Kev. Well, I appreciate you so much for jumping on today and giving all your feedback. It was great knowledge. I know a lot of people took a bunch of notes just like I did. How can people get a hold of you to connect?
Well, you can reach out to me via Facebook, Instagram, or LinkedIn. There are a lot of Kevin Ings out there.
Is there?
That's a funny thing. A client of mine trying to give me a 5-star review on Google. She gave it to a different Kevin Ing who works at TD Bank, who also does mortgage in Long Island.
That's hilarious.
So I am a Kevin Ing who works for Evolution Mortgage, and I'm in New York. And you can also email me at kevin@evomtg.com. Kevin@evolutionmortgage.com, basically, evomtg.com.
Perfect. I love it. Well, I appreciate you jumping on today. It was great knowledge. And it's exciting to see the times that we're in, to really see that there's still hope. There's still opportunities out there. And I know you're
always.
Yeah, always. That's right. It's calculated risk. So guys, reach out to Kevin if you have any mortgage, lending, type of inquiries or comments, concerns, anything. If you just want to connect more, I highly encourage. Otherwise, if you want to get a hold of me, you can always do so on Instagram. It's Brandon Elliott Investments. Otherwise, facebook.com/Brandon Elliott Investor. If you are looking to get really, truly educated on everything that we got going on in our mastermind for Credit Counsel Elite, check out creditcounselelite.com. That's www.creditcounselelite.com. We have a live webinar on there that you can watch. It's about an hour long. It will really show you all of the possibilities of credit and how to be able to flip the script on the banks, how to fix credit very quickly, but treat this credit space and understanding behind it just like it's real life monopoly, right? And how to be able to become the bank sooner than later, fixing credit quickly, how to be able to get massive lines of credit, several 6 figures, even 7 figures in funding, and then be able to leverage it into real estate or anything that you're passionate about. That if money was ever the issue, let's eliminate that by getting 0% interest credit. We teach travel hacking as well, so all that fun stuff in between. But we will catch you on the very next episode next week. Make sure you hit that subscribe button so you got the newest notification every single Monday when the new episode drops, and then leave that 5-star review if you found value in this. Love you guys all so much. We will catch you on the next one. Till next time, God bless. Kevin, appreciate you as always. Talk soon.
Thank you, Brandon.
This has been another episode of Ready, Set, Go Real Estate Investing Podcast, brought to you by Brandon Elliott. For more information, please visit BrandonElliottInvestments.com. Also, please don't forget to like, share, and leave a comment below. Thanks again for joining. Until next time, God bless.